Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. I've been helping clients avoid inheritance tax for more than 18 years as a specialist, and today's video is all around how does an estate planning structure actually help to avoid inheritance tax. Hello, welcome back. So today's video is around why an estate planning structure can also help to avoid inheritance tax. Now, very simply, an estate planning structure is wills with embedded immediate post-death interest trusts. There's some videos on that if you want to look that up on my channel, and also some joint settler trusts if you're a married couple, or single settler trusts if not. But it's a structure of wills together with immediate post-death interest trusts together with other lifetime trusts. In other words, it's important the trusts are set up during lifetime. Again, there's a video explaining what that's about. So effectively, it's a methodology of setting up a series of trusts and wills so that when you die, your assets then fall into this structure. So how does this save tax? Okay, so let's say you've got a house worth $1 million. Right. When the first person dies, they have an allowance of $325,000. So instead of passing that allowance to their spouse, it effectively passes that $325,000 to a trust. Now, it's not just the allowance that passes. You actually get a conveyancing solicitor to put a percentage of the house into the trust. Now, it depends on the value. If you've got a house that's worth $650,000, half the value of the house would go into the trust. If you've got it worth $1 million, just under 1/3 of the house would go into the trust. But it's important to understand it's a percentage of the house which is now owned by that trust. Now, the rest of the assets go to the surviving spouse, unless there is a case where the surviving spouse is likely to have assets that exceed $2 million, in which case an immediate post-death interest trust is also put into place, and that has the potential for saving £70,000, because by banking that immediate post-death interest trust into that, by banking the residential nil rate band into that immediate post-death interest trust, and then the surviving spouse dies with over 2 million, you've just saved £70,000, because that's 40% of 175,000. So there's one tax saving. But going back to the property and going into trust. Now, the basic premise is that the property is likely to grow a lot faster than the allowance for inheritance tax, because the allowance has already been frozen 10 years. It's frozen until 2026, and who knows what's going to happen then. It could be frozen another 10 years. So by putting a percentage of the property into the trust, let's say the property grows at 3.5% a year, right? So therefore you've got growth on 325,000, which is about £11,400. 40% of that is £4,550. So potentially for every year there is a gap between husband and wife dying, there is a £4,500 tax saving. But so let's say if there's a 10-year gap, basically you've got 45,000 plus saved in inheritance tax. On top of that, there is an additional issue, so that it says it is more of an accounting principle than it is a inheritance tax rule. So when an asset is owned by two separate people, or in this case two separate legal entities, the trust being one person and the surviving spouse being the other, when the surviving spouse dies, the value of the property in her estate is reduced by 10%. That's the figure that the HMRC are currently using at this moment, right? So let's say if the house was worth $1 million when you first did it, 325 goes into the trust when the first person dies, but then by the time the second spouse dies, the property is still $1 million in her estate. Let's say if the husband dies first, right? So what happens then? Her $1 million is reduced by 10%, which is 100,000. 40% of that is 40,000. We just saved another £40,000. So if there's a 10-year gap plus the house is worth £1 million on the second death, there's potentially £80,000 saved there. Not to be sniffed at, to be honest. For a lot of our clients, that's not a big percentage of their estate, but it is significant, and £80,000 is still an awful lot of money, almost by anybody's imagination. So that's how an estate planning structure can save inheritance tax. Last but not least, hopefully very rarely used, but deathbed planning. Effectively, if we get a phone call from the children saying that the surviving spouse just gone into hospital, very ill, the doctor's not giving them long to live, we could put a whole bunch of assets into one of our lifetime trusts while that person is still alive. It would fail for inheritance tax purposes because of the potentially exempt transfer rules being 7 years. But of course it would reduce the estate for probate purposes. So if we bought the estate under 2 million, then we've just saved another residential new rate band, which is potentially another £70,000. So quite a lot of tax savings to be made for effectively a structure that's designed more for protection for the children and the grandchildren for the long term, for retaining assets within the family base. So that's how the inheritance tax on the estate planning structure works. If you want to know more about it, you should watch my longer video on why estate planning is more important than inheritance tax planning. You'll find that on my YouTube channel or on my website. Okay, if you found that useful, please give us a thumbs up, to like the video, and because it really does help the channel. And then also, if you want to subscribe, feel free. However, thanks very much for listening, and goodbye for now. Bye.